Hi there, I'm Jason Ayers, founder and president of OptionsSource.net, and thank you for joining us to learn how you can protect your portfolio with the help of index options. Investors have been facing very challenging market conditions over the last few years, and asset preservation has been one of the main concerns when managing their portfolio. Some investors decided to liquidate their assets and instead invest in a more secure type of vehicle such as money market funds. Others tried to take advantage of the volatile markets and have been trading in and out of positions. Today, we will look at another alternative, which is the use of put options to hedge the risk associated with an entire, well-diversified portfolio. If an investor is concerned about short-term risk, one way to hedge would be to buy put options on each security. As we have seen in previous videos, as the market declines, put options should increase in value and subsequently completely or partially offset the loss incurred on the portfolio. However, purchasing puts on each individual security that makes up the portfolio can be very costly. Therefore, since a diversified portfolio will usually follow the market, a more cost-effective way to protect the portfolio would be to use SXO options. As we have seen in previous videos, SXO options are priced in relation to the S&P/TSX 60 and are often used by investors to hedge their portfolio against a broad market decline. As with equity options, the SXO put options will increase in value as the S&P/TSX 60 index decreases in value, which will completely or partially offset the loss incurred on the portfolio. The protective put strategy is very easy to implement and provides great benefits. First, SXO options offer a very cost-effective solution for managing market risk in a portfolio. Also, because these options are cash settled, investors do not have to sell shares to reduce risk exposure and buy them back once the market appears less risky. This reduces transaction costs, allows for the continued collection of dividends, and eliminates tax dispositions. In order to effectively hedge a diversified portfolio, the investor must first determine how many SXO options to purchase. The number of put contracts needed to properly hedge the diversified portfolio can be obtained by multiplying the portfolio value by its beta and dividing the result by the value of the S&P/TSX 60 multiplied by 10, which is the SXO option multiplier. In order to use the formula, we first need to collect all the variables. The first step involves determining the beta of the portfolio. The beta of a portfolio indicates the volatility of its return in comparison to the market as a whole, usually represented by an index. In this case, the S&P/TSX 60 index will be used as a benchmark. A beta of 1 represents the market. Consequently, a portfolio that moves more than the market over time will have a beta greater than 1, and a portfolio that moves less than the market will have a value below 1. For example, with the beta of the market being 1, if the market rises by 3%, a security with a beta of 2 indicates that the portfolio would rise by 6%. On the other hand, if the beta is 0.5, the portfolio will only rise by 1.5%. Note that a positive beta indicates that the security is moving in the same direction as the market, whether it rises or falls. Beta may also be expressed as a negative value. A negative beta indicates that the security tends to move in the opposite direction of the market. Using the previous example of an increase of 3% in the market, a portfolio with a beta of -3 would decline 9%. A stock's beta can be accessed through a number of financial websites. Each security in a portfolio will have its own beta. Therefore, once the beta of each security has been retrieved, the investor would need to calculate the average beta of the portfolio. The average is obtained by multiplying the beta of each stock with its corresponding weight in the portfolio and adding the results obtained. In this example, all securities are equally weighted. The betas are simply added together and averaged by the number of companies. The result is an average portfolio beta of 1.37. Let's now look at an example with an investor who holds a $100,000 portfolio with an average beta of 1.37. Let's now assume that the S&P TSX 60 index is at 660 and that a 2-month 660 strike put option is trading at $19. Referring back to the original formula, to determine the optimal number of put options to purchase, we multiply the portfolio value by the portfolio beta of 1.37. The result is then divided by the S&P TSX 60 index value times 10. The result is 20.76 contracts. Since a partial contract cannot be purchased, the investor may elect to buy 21 contracts. To obtain the total cost of the hedge, the investor multiplies the put option premium by 10, which is the multiplier, and by the number of contracts. In this example, the investor would multiply the $19 premium by 10 to arrive at a value of $190, which is then multiplied by the 21 contracts for a total cost of $3,990. Let's now look at the impact of the drop on the portfolio with the hedge and without the hedge in place. Without the hedge in place, a 10% drop in the index would result in an approximate 13.7% drop in the portfolio, which represents $13,700. Remember that the beta of the portfolio is 1.37, which is used to calculate the dollar fluctuation in the portfolio. The portfolio value would therefore be approximately $86,300 after the market decline. With the hedge in place, if the S&P TSX 60 index declined by 10% to 594, the loss on the portfolio is still $13,700. However, the put option would have value. In order to obtain this value, the investor would subtract the current index value of 594 from the put strike of 660, which leads to an intrinsic value of 66. $66 is the settlement value. The initial cost of the option is then subtracted from the settlement value of $66 to determine the net profit of the option position. In this example, $19 is subtracted from $66 to arrive at a net profit of $47. To determine the total profit, we multiply $47 by the multiplier of 10 and then multiply by the number of contracts, which is 21. The total profit from the options position is $9,870. With the hedge in place, the investor reduced their loss by the amount of $9,870. The portfolio value would now be $96,170 as opposed to $86,300. Remember that SXO options are cash settled, and as a result, the SXO option holder's trading account would be credited by an amount of 9,870 Canadian dollars at expiration. It is also important to note that the settlement value is based on the opening level of the S&P TSX 60 on the expiration date of the options. Therefore, if you wish to close your position prior to expiration, remember that the last trading day is the day prior to the expiration date. Thank you for joining us.